Greetings all! Welcome to my training focused channel. I go by the name Polly. I established this YouTube channel with the intention of sharing my knowledge and insights, so be sure to hit that subscribe button because there is a wealth of engaging content of the horizon. For those interested in joining me for training sessions and receiving signals, don't forget to subscribe to my Telegram channel, of course. You can find the link in the video description. So today I will show you a very interesting strategy that involves using 4 indicators: 3 moving averages and the MACD. What is moving average, convergence and divergence? MACD. MACD is a trend following momentum indicator that shows the relationship between 2 exponential moving averages of the securities price. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. The result of that calculation is the MACD line. The EMA of the MACD line is called the signal line, which is that plotted on top of the MACD line, which can function as trigger for buy or sell signals. Traders may buy the security when the MACD line crosses above the signal line and sell or short the security when the MACD line crosses below the signal line. MACD indicators can be interpreted in several ways, but the more common methods are crossovers, divergences, and rapid rises or falls. MACD has a positive value as shown as a blue line in the lower chart, whenever the 12-period EMA indicated by the red line of the price chart is above the 26-period EMA, the blue line in the price chart, and a negative value when the 12-period EMA is below the 26-period EMA. The level of distance that MACD is above or below its baseline indicates that the distance between the 2 EMAs is growing. MACD is often displayed with a histogram that graphs the distance between MACD and its signal line. If MACD is above the signal line, the histogram will be above the MACD's baseline or zero line. If MACD is below the signal line, the histogram will be below the MACD's line. Traders use the MACD histogram to identify when the bullish or bearish momentum is high, and possibly for overbought or oversold signals. One of the main problems with the moving average divergence is that it can often signal a possible reversal, but then no actual reversal happens. It produces a false positive. The other problem is that divergence does not forecast all reversals. In other words, it predicts too many reversals that don't occur and not enough real price reversals. This suggests confirmation should be issued by trend-following indicators, such as Directional Momentum Index system and its key component, the Average Directional Index. The ADX is designed to indicate whether a trend is in place or not, with the reading about 25 indicating a trend is in place or reading below 20 suggesting no trend is in place. Investors following MACD crossovers and divergences should double-check with the ADX before making a trend on a MACD signal. For example, while MACD may be showing a bearish divergence, a check of the ADX may tell you that a trend higher is in place, in which case you would avoid the bearish MACD trend signal and wait to see how the market develops over the next few days. And furthermore, false positive divergences occur when the price on an asset moves sideways in a consolidation such as in a range of triangle pattern following a trend. A slowdown in the momentum sideways movement or slow trending movement of the price will cause MACD to pull away from its prior extremes and gravitate towards the zero lines even in the absence of the true reversal. And again, double-check the ADX to determine whether a trend is in place and also look at what price is doing before acting. So what is a moving average, EMA? In finance, a moving average is a stock indicator commonly used in technical analysis. The reason for calculating the moving averages of stock is to help smooth out the price data by creating and constantly updates average price. By calculating the moving average, the impact of random short-term fluctuations of the price of the stock over a specific time frame and mitigated. Simple moving average uses simply arithmetic average of prices over some time span, while exponential moving average place greater weight on more recent prices than other ones over the time periods. Moving averages are calculated to identify the trend direction of stock or to determine its support and resistance levels. It is a trend following or lagging indicator because it is based on the past prices. The longer the period for the moving average, the greater the lag. A 200-day moving average will have a much greater degree of lag than 20-day EMA because it is countless price for the past 200 days. 50-day and 200-day moving average figures are widely followed by investors and traders and are considered to be important trading signals. Investors may choose different periods of variant length to calculate moving averages based on their trading objectives. Short moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investors. While it is impossible to predict the future movement of specific stock, using technical analysis and research can help make better predictions. A rising moving average indicates that the security is on an uptrend, while a declining moving average indicates that it's a downtrend. Similarly, upward movement is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a long-term moving average. Conversely, downward movement is confirmed with a bearish crossover, which occurs when a short-term moving average crosses below a longer-term moving average. So let's examine the real-world application of this strategy. If it appears complex initially, it's just a first impression. In reality, this strategy is quite straightforward despite its use of multiple indicators. We've chosen the AUD and Japanese yen currency pair for a 3 minutes upward trade. Now let's dissect the indicators. To start, the fast-moving average crosses both of the long-term moving averages, triggering the formation of the green bars. The first lines are on the verge of interesting at the MACD. Now let's delve a bit deeper into the strategy itself. I utilize 4 indicators, 3 moving averages and the MACD. The moving averages are set at 85, 75, and 5, with the first 2 representing a long-term moving average. The third, with a 5-bar period, serves as the fast-moving average. The MACD indicator is configured with a parameters of 50 and 26. This strategy has proven effective for me when applied to a 1-minute time frame with a 3-candle expiration period. In essence, it's a highly absolute strategy that functions effectively in various market conditions. The only prerequisite is deploying it within a trend. In this instance, we're experiencing an upward trend, so I'm applying this strategy accordingly. It performs notably better during a trend compared to flat or volatile market phases. So now let's address entry points. I enter a trend on an upward trajectory when the fast-moving average crosses both slow-moving averages from the bottom to top. Similarly, green bars should manifest of the MACD. For a downward trade, I initiate it when the fast-moving average crosses both slow-moving averages from the top to bottom and red bars surface on the MACD. It's even more favorable than the MACD signal lines. Interpret the indicator at the 0 level concurrently. This strategy can be further optimized. For instance, in cases where the market remains in a protracted sideways or flat movement, it's likely to culminate in a robust trend. During such scenarios, you can prefigure all the indicators are await the signal to open a trade when the first indications of the reversal emerge, specifically a definite crossover of the moving averages. Another consideration is the trader's expiration time. Instead of 3 minutes, you can opt for 5 or 7 minutes. In situations market be a consistent trend, you can simultaneously initiate and multiply trades with the varying expiration times to maximize profits from the price fluctuation while mitigating risks. This is our recommendation. My recommendations, guys, for implementing for a good color strategy. I occasionally employ that even when the market is trading. In summary, it's a straightforward and dependable system suitable for conservative trading with unstable uptrends or downtrends. As I indicated, the strategy is working. The trade concluded with a profit. Despite entering at a relatively high point, I still secured a confident profit. The strategy is quite well automated, but like any scalping system on a 1-minute time frame, it is better to trade manually. This will help effectively fine-tune the strategy for MACD reversal signals, bounce out of moving averages, and achieve consistent daily profits. Thank you for your watching. Like and subscribe to the channel. If you wanted to participate in trading session with me and receive signals from me, then subscribe to my Telegram channel. The link in the description. My name is Polly, and I'm the best trader. See you.